With the boom of AMC and GameStop and many other momentum stocks in the market right now and everything going on a bull run, a few topics are really coming into light, and these are shorts and naked shorts. And that's exactly what we're going to learn about in this video today. So let's start with shorts, or in textbook known as a covered short. Simply by definition, a covered short means that the short seller has already borrowed or has located or arranged to borrow the shares that when the short sale is made. Whereas a naked short means that the short seller is selling shares it doesn't own and has made no arrangements to purchase. The seller cannot cover or settle in this instance, which means they're selling a ghost or a phantom share that simply does not exist without their action. Here's an example. Imagine you have Steve. Steve is a short seller. Let's call him short seller Steve. You then have Bob the buyer, and lastly you have the brokerage firm that handles all the stocks. These would be your Fidelity, your E-Trade, your Charles Schwab, and so on. Day one. Steve the shorter believes that the value of Cabbage Corp will go down, so they ask to lend or borrow 100 shares of Cabbage Corp stocks from the brokerage firm, which are going currently for $10 per share, meaning that he borrowed about $1,000 worth of shares. The key word here is borrowed. However, the brokerage firm doesn't let them borrow it for free, but charges a daily interest of 10% on the lent amount of shares until those shares outstanding are returned. On day one, Steve the shorter immediately goes and sells the shares to Bob the buyer, who is bullish or is positive that the value of Cabbage Corp will increase. Steve the seller now has $1,000 but is paying 10% interest daily on the borrowed Cabbage Corp shares, in which he owes to the brokerage firm. On day two, the value of Cabbage Corp drastically falls to $4 per share due to a natural disaster of its farmlands. Steve the shorter goes and buys back the number of shares that he needs to return to the brokerage firm. Steve spends $400 to buy back the 100 shares of Cabbage Corp stock. Steve then gives back the lent shares and the owed interest amount to the brokerage firm for allowing him to lend the shares. This cost Steve the shorter a total of $200 for borrowing the shares for 2 days. This is calculated by 10% of the original value of the lent amount, that being $1,000, which yields $100 for day one and then another $100 for day two, totaling $200. Steve the shorter also spent $400 buying back the shares to give back to the firm. So in total, Steve the shorter spent $200 on interest and $400 on the shares, meaning he spent $600 in total. However, when Steve the shorter initially sold the borrowed stocks, he made $1,000. And after deductions, Steve the shorter profited $400. In covered shorting, it required Steve the shorter to borrow the shares first before being able to sell it. But here we have Nathaniel the Naked Shorter. And Nathaniel is mischievous. See, he decides to sell a stock that he doesn't currently own or borrows. He essentially sells nothing but a promise, covered under the light of an IOU. An IOU is literally what it sounds like. An IOU, a phonetic acronym of the words I owe you. And it's a document that essentially says, hey, I accept the fact that I owe you debt. See, naked short selling is selling shares of a stock and then failing to deliver them. This would seem to be fraud, with the exception that the system creates a sort of an IOU, and it keeps track so that at some point the short seller will have to what's known as covering his sale by buying back the shares. So Nathaniel the Naked Shorter goes to Bob the buyer and then sells him a share of Cabbage Corp that Nathaniel doesn't own. However, when it comes to giving them the real share, Nathaniel's betting on the stock going down on price and buying it then, and then giving it to Bob the buyer. So what's wrong with naked shorting? Well, in isolation, not a lot. See, an occasional failure is normal and it happens. A failing to deliver on a sale has the same impact on share prices as a traditional short sale what a borrowed stock might. The problem, however, is the act of borrowing shares provides a limiting factor because you can only borrow, for example, for however many pens I have to give you, I can only give you so many. But the problem that exists with naked shorting is that you can essentially borrow an unlimited amount. There's not a limit, so I can always just lend you out pens even though I don't have any pens or anything to give you. And I essentially create an IOU, which essentially becomes the equivalent of a counterfeit share that floods the market. And at the same time, mass selling dampens the demand of that stock. And because on Wall Street, mass selling suggests that something is wrong and new buyers are scared away because everyone is selling the stock. But they don't know that a lot of them could be naked stocks or synthetic shares. Thus, in large enough amounts, naked short selling simultaneously increases the supply and decreases the demand, which results in a rapidly decreasing price. And in the terms of the laws of supply and demand, that means it's a stock that's not worth buying. So in naked shorting, the trader has not borrowed or arranged to borrow from their broker shares to sell short. Therefore, when they make a short sell, they're basically selling something they don't have. It results in what is known as a failure to deliver the shares to the buyer. And when a short sale of a stock occurs, the shares sold must be delivered to the buyer within 3 days. Otherwise, a failure to deliver results and the transaction is canceled. So a trader who engages in naked shorting hopes to close out their short sale at a profit before their expiration of the required 3-day settlement time frame. In which case, when they fail, they would have to buy the share and deliver it to the person they owe it to. Now that you know the exact difference between shorts and naked shorts, that may give you a better idea on the current situation of many of these stocks and the drive for millions of retail investors for these stocks. So when there is naked shorts for AMC or GameStop, hypothetically, that would mean that at a certain point, these naked shorters would have to cover their sales, which means at whatever cost, they would need to buy those shares at whatever market value and then give it back to the buyers who bought it for because they owe them an IOU and they must be covered. So I hope you understand why this is a big deal and how it all plays into this. Let me know below on a topic you'd like me to cover, and as always, like and subscribe, and more than anything, share this with others that you think would appreciate knowing the finer details about trading. All right, peace.